Hello, and welcome to Macro Minutes. During each episode, we will be joined by RBC Capital Markets experts to provide high-conviction insights on the latest developments in financial markets and the global economy. Please listen to the end of this recording for important disclosures.
Welcome back to Macro Minutes. My name is Peter Schaffrik, and the title of this week's episode is Weakest Links. Today is the 1st of April, 2026, and I promise you this is not an April's Fool recording session. So the all-consuming topic for markets, of course, is the conflict in the Middle East and the grip it has on markets. Early on in the crisis, we've been pointing out that this is much more than just oil and gas, but that the way this crisis can work its way through many economies and markets is by A, sapping some key industries in specifically Asia and the APEC region, where most of the deliveries out of the Middle East actually go into, and B, the inflationary forces, or rather stagflationary forces, that the process unfolds in almost all economies around the world. Today, I would like to explore these channels a bit by speaking to Rob Thompson in Sydney, who has written a fascinating report last week highlighting that even a commodity exporter like Australia feels the pinch quite strongly, which is probably not what most people had on their bingo card when the war broke out. And also by Izaac and myself outlining a little bit the discussion around the central bank's reaction function and which part of the stagflationary shock, the inflation part or the recessionary part, are driving the reaction functions more. We also have Calvasina on the call, and she's hopefully going to help us understand why even up to this day, the US equity market's reaction function has been quite tepid. So let's start with Rob in Australia. Rob, as I just said, you've published what I think is a great note, and you point out that whilst Australia is a net energy exporter, it paradoxically finds itself quite vulnerable to this shock. Why is that?
Hi, and thanks, Peter. We find ourselves in an odd position down here in Australia. Ordinarily, we'd think of ourselves as positively exposed to commodity or energy shocks, as we're such a large net exporter. After Russia invaded Ukraine in 2022, for instance, we saw a huge terms of trade boost via higher coal and LNG prices, which supported national income and so on. Consumers felt some pain via high energy prices, of course, but relative to other parts of the world, and particularly Europe, the downsides weren't that bad. Fast forward to now, however, and the story for Australia is a little different. While we remain a net energy exporter in aggregate to the tune of around 1% of GDP, we've long been a refined petroleum importer. Given war in the Middle East has affected Asian supply lines of oil so heavily, and given we import 80 to 90% of our refined fuel across petrol, diesel, and jet fuel, we found ourselves facing not only much higher fuel prices than in 2022, but also facing the non-zero chance of fuel shortages. So we've got a heavy dependency on fuel imports, with only 2 refineries still operating in the country. And given our geography, we source most of this from Asia, which has of course been the most heavily affected region. Adding to this, we're the only IEA member who hasn't been meeting our fuel reserve requirements. We only keep around 30 days of fuel stock in country, which is well short of the 90 days required by IEA standards. We'll still see some terms of trade benefit from higher gas and coal prices as a country, but it's oil-based fuel and our supply line weakness that is suddenly a much more acute problem for both inflation and growth than people might at first glance assume, given our status as a net energy exporter.
Okay, Rob, so what kind of policy response have we seen from the Australian government to date?
Well, Peter, it took them a month or so, but eventually the federal government earlier this week took the most obvious course of action available, which was to cut taxes on fuel. They've halved what we call the fuel excise tax, and they've also cut the road user charge for heavy vehicles to zero. Both had been announced for 3 months. The end result is that everyday consumers are facing about a 40% increase in petrol prices instead of a 60% odd increase. So it's still a huge shock. And some forms of fuel like diesel have gone up a lot more than petrol too, and have a lot more sensitivity for businesses and for those, especially in the regions. Trucking companies are huge in Australia, given our geography. That's been felt a lot worse than just a 40% petrol price increase. As for the background, though, part of the reason for the delay in the government coming in to cut these fuel excise taxes and things is that they have been talking tough on the need for fiscal restraint heading into the May budget. They didn't seem overly keen to open the purse strings too quickly as the shock developed. But really, they had little choice to do something in the end. We're not surprised at all to see some of these measures starting to come through. Would say it's early days. Things are starting to move quite quickly now. And quite honestly, by the time this podcast goes out, we might have seen further announcements from the Australian various levels of government. So stay tuned on that front. But going back to this initial round of support, the cost is around $2.5 billion over 3 months, or about 0.4% of GDP. Compared to COVID era fiscal support, this is just a drop in the ocean, really. We had a similar course of action taken in 2022, which lasted for about 6 months. Treasury estimates that this will lop off around 0.5 percentage point from headline inflation. But of course, this is from a starting point, probably well over 5% in annual terms. We'd warn, though, that this cut in taxes for 3 months is also likely just to start, and there could be an extension of this, and of course, further measures taken. They'll just keep rolling the cuts if they feel that it's necessary. States are also yet to fully outline the relief that they're going to offer to households and businesses. Some have announced some free public transport, but we think there's a lot more to come on that front as well. Given we're looking at potentially true supply shortages, though, not just higher prices, I would add that the word rationing is starting to be bandied around here as well. We've got a bit over a month of various key forms of fuel in country at the moment, well short, of course, as mentioned earlier, of our 90-day supposed requirement. And there are still shipments of fuel en route, but we may start to see levels dip as we get through April and into May, and shipments from Asia specifically start to dry up a little bit. Government's also making various efforts to support fresh purchases from both Asia and refineries elsewhere, including offering to underwrite, including by other efforts to underwrite shipping insurance, and by using so-called LNG diplomacy, using energy that we do have in supply as leverage in negotiating for further fuel supplies. But the next steps, if we think about where the government is in terms of its national action plan, would be first for voluntary, and then eventually for some form of compulsory fuel rationing, which of course we're already seeing in various forms through other parts of Asia. And that really starts to open up a discussion around negative consequences for growth going forward.
Let's drive it to market then as a follow-up. So the RBA was obviously already tightening before the energy shock kicked in. Could they now be forced to take the cash rate even beyond the prior peak of 4.35?
It's not currently our base case, but yes, it's entirely possible. The RBA is finding itself unable to look through the supply shock, given we were already facing a tight supply-demand environment heading in before the Middle Eastern conflict kicked off. And of course, they already hiked rates in February purely on domestic factors, then followed it up with another hike in March. We expect them to go again for a third consecutive time in May, which would take the cash rate back to that 4.35 level. The bank's got no choice really but to prevent inflationary pressures, and particularly inflation expectations, from getting further out of hand. As outlined earlier, it's fiscal policy which has the task of preventing growth risks from getting too large, given our vulnerability through the fuel supply lines. If that adds to the RBA's task in terms of adding a bit of demand that otherwise wouldn't be there, then so be it. So we still have 4.35 as our terminal cash rate call for this cycle. But look, we're not going to die in a ditch defending it. Markets are currently pricing terminal around 4.65, so a bit over one additional hike over on top of our base case. And briefly, markets had it as high as around 5%. So there's nothing controversial in saying that the risks are skewed to more hikes than our base case, not less. We'll see if we need to further modify our profile over the next few weeks. Where we think there's value in market space, though, in rates, is positioning for further front-end curve inversion in Aussie as a function of greater growth slowdown risks. If the RBA is forced to take policy tighter to contain inflation, then it may well find itself needing to cut harder than markets are currently factoring in towards the back end of the year or into 2028 as those growth risks start to come more to the fore.
Thanks, Rob. I think this is a very good segue into central banks and policy responses. And before I bring in Izaac to speak about the Fed, just a very brief update from my side here in Europe on the ECB and the Bank of England. So we have put a note out where we argued that if push comes to shove, if they have to pick a poison between two potential policy mistakes, one being doing nothing and then later find out that it is a stagflationary impulse, a little bit like 2022 with a wage price spiral, or B, the policy response or the potential policy mistake of going against inflation now and later finding out that the economy is taking a turn for the worse and having to correct course, they would probably pick going against inflation. That's the central learning that the central banks have accumulated over the past years. And they would probably also argue that reversing course later on by reducing rates, if need be, is easier than the other way around. Now, my personal takeaway for the market is still that they will buy time. They will need data to assess which way they're going. They won't go into a policy response very quickly. Therefore, we think that the implied rate hiking probability, let's say for the April meeting, looks too much. And we would go against that, but we wouldn't necessarily go against the rate hikes that are currently priced into the curve. Having said all that, I would postulate that for most of the world, the impact will be felt more strongly than for the US. I thus personally find sussing out what the Fed will do much harder than what the ECB potentially will do or the Bank of England. But thankfully, we've got somebody on the call who's much closer to the action over there in the US, and therefore let's bring in Izaac. And maybe, Izaac, if I can rewind the clock a bit, I just talked about the Bank of England and the ECB. Markets clearly had taken a hawkish tilt from the March FOMC meeting. So do you think that was justified in the first place?
Yeah, thanks, Peter. So yeah, clearly there was a hawkish read from the March FOMC. I think that was a continuation of what we really saw since this war kicked off. The U.S. front end sold off alongside moves higher in oil, the moves higher in global front end rates. But into that March FOMC meeting, we were still pricing a cut for the Fed for this year. And there was some expectations for dovishness out of Powell at the meeting. So we went into the meeting, hoping for a dovish outcome, but fearing a hawkish one. At first glance, 2 p.m. when we got the meeting materials, it looked like that hawkish scenario was avoided. The 2026 SEP dot continued to show 1 cut for the year. There was a risk that it shifted up to imply 0 cuts. So market participants were relatively comfortable that maybe we had avoided those kind of hawkish risks. But then in the press conference, Powell downplayed those SEP dots even more so than he usually did. He was somewhat dismissive of the weakness in the February jobs report, and he acknowledged that hikes had been discussed around the table. Now, again, that isn't new information. The hike discussion also came up in January. That's not a we need to hike in the near term. It's just a discussion of what conditions could get them to hikes. But still, the market went into that meeting hoping for a dovish outcome, fearing a hawkish one. And when you got those kind of hawkish catalysts out of Powell, even if I don't think they were that meaningful relative to what we already knew the FOMC was thinking of, the market really ran with it. And so, we saw last week, that opened the door to new hawkish highs in Fed pricing. We completely priced out cuts. At one point last week, we were pricing a 50% chance of a hike by the end of the year. We did think a lot of that was overdone, that price action really reflected, more of sideline dip buyers amidst high volatility than it did a fundamental shift in what the Fed was actually going to do this year. And that move has come back a fair bit since then. I think that's been partially a story of broader stabilization in rates, but Powell certainly helped on Monday. He came out and did kind of push back on that hawkish pricing a bit more by noting up front that monetary policy does not have a meaningful impact on supply shocks, which was definitely a step further than he went at the FOMC meeting. So with that backdrop, we have kind of shifted back to removing the hike probability, and markets are back to pricing roughly 1/3 chance of a cut this year, but we're still in a relatively hawkish Fed backdrop right now.
Yeah, thank you, Izaac. I think that all makes sense. So what do you think going forward from here? What's the outlook for the Fed? What are rate hikes really on the menu?
Yeah, so as listeners will know, we've long had a no cuts in 2026 base case. What I really think the developments of the past month have done is reinforce that base case. even if the conflict resolves in the near term, there's still going to be some level of upward impact on inflation data. It's probably going to take several months for that to kind of work its way into the data. And don't forget that before this Iran conflict started, there was already expectations of upward pressure on inflation into mid-year. And in that backdrop, too, the labor market has seemed pretty stable since concerns arose last year. We've had a lot of Fed speakers recently. All of them sound pretty unified in this view that rates are going to be on hold for some time, but nobody is talking up that hike case. We still think the next move will eventually be a cut. We're penciling in, 3 more 25 basis point adjustment cuts in 2027 as inflation does finally come back down. And I do think, over the past several weeks, I think the risk around that call is still skewed towards those cuts being pulled forward into late 2026 rather than removed altogether or replaced with hikes. That's because we really do think that the Fed would put more weight on the potential growth negative impacts of a prolonged energy shock rather than the upfront inflationary impacts. And overall, I do think the bar to hikes here is very high and unlikely to be reached. For one, the Fed clearly doesn't want to hike into a supply shock. Powell said as much on Monday. I think, most Fed officials do think rates are in restrictive territory, so they're already positioned to lean against inflationary pressures. That's very different from the policy stances of some of the other major central banks. But the biggest reason why we don't think hikes are a high probability right now is that the Fed is a dual mandate central bank. And while labor markets have stabilized since the concerns arose last summer, they still don't look great. The risk there is still skewed to the downside. To me, the conditions that would really get the Fed concerned about the need to potentially hike, that really depends on wage pressure, and that really depends on a tight labor market. And current labor market conditions seem pretty far away off of that. The other warning we've heard from Fed officials is that if longer term inflation expectations get unanchored, that could lead to hikes. But again, for that to happen, I do think you need to see a tight labor market and a strong economy. And again, that's not really the backdrop here. If you look at long end inflation break evens, which spiked in 2022 when energy prices spiked, those are actually lower since the war broke out. So the market clearly isn't that worried about that scenario at this point. If hikes were going to happen, I think that's a longer term story, maybe a 2027 story, and it would take a slow burn, an accumulation of data, and a tightening of the labor market, a tightening of the economy. And I still don't think that that's very likely at this point. So for now, just to wrap up, I'd say our base case is still 0 cuts in 2026, 3 cuts in 2027. We do not see hikes as likely as an outcome of this.
Thank you, Izaac. So basically, with the Fed on hold for an extended period of time, what do you think that means for the broader rate complex in the US?
Yeah, so just briefly on that, I do think in the near term, things are going to be pretty sticky around current levels. We've kind of stabilized after the war-induced volatility, and the focus is kind of shifting from, upfront inflationary impacts to the longer term growth negative impacts. But I do think that it's hard for yields to continue to move lower. It's hard to price more than one Fed cut without real catalysts for dovishness in the economic data. And that's not really something our economics team is expecting to see in the near term. Meanwhile, we are likely to see upward pressure on inflation in the coming months. With growth in labor steady and upward pressure on inflation, that's not really an environment where I'd expect to see a big bullish rates move. Longer term, I do think things will shift back in the dovish direction, but I do think for now things are probably pretty sticky, choppy, and sideways. And Fed pricing is probably going to struggle to really price anything more than one cut for this year.
Thank you, Izaac. We've talked a lot about the economy, about rates, central banks, and I'd like to shift gears a little bit and move towards the risky assets, equity markets. So we've got Laurie with us. Thank you, Laurie, for being with us. And I start off with sort of a question maybe a little bit away from directly the equity market. You're traveling around the US a lot, seeing investors. I know that. What's the vibe that you're currently getting? How are investors thinking about the situation in the Middle East at present?
It's a great question to start with, Peter. And, in my meetings, I would say over the past week and a half, I really want to emphasize that investors I speak with are concerned. They're confused in terms of the end game of the situation in the Middle East. I have floated the idea that we're in a discovery process of learning what all these ripple effects are, and I think they're generally in agreement with that. They're not panicked, but they're very thoughtful. They're very patient. And I want to bring this up because there have been some accusations of complacency among U.S. equity investors, and that's simply not what I'm seeing on the road. I will say that they are not doing much in terms of trades. Many on the hedge fund side are well hedged. Many of the long onlys are already up the quality spectrum. So those are things that serve them well and have given them the ability to be somewhat patient here. In terms of key questions that are coming up, I've been keeping close tabs on the discussion going on in the fixed income market, talking to Izaac and our rate strategist, Blake Gwynn, very regularly. And I am simply not getting a lot of questions about the Fed, and we're not sensing, that investors in my world are really anticipating hikes. And I definitely believe I would be hearing it if they were, because they do tend to try to pull us into the Fed conversations. I think there's been a view out there that in the US, this is more of an inflation shock than a growth shock. And I would say that's where most of the investors I speak with, where their heads are leaning. That being said, while we're not getting calls for a recession, the word stagflation does come up. And we're starting to get questions about when earnings impacts are going to be understood. We've obviously got an important reporting season starting up here later this month. Overall, I would say the critical question that people have been focused on is the duration of the war, with most people falling into the camp of it'll be another week, maybe a few more weeks. I had one investor tell me it'll be a few more months, but that was an outlier. But I do think that, sort of the views on growth and duration, that those are linked in people's heads. But that's what I'm seeing just in conversations right now.
Okay, thank you, Laurie. I mean, you just mentioned there's no complacency, but certainly what we're seeing is resilience in the US equity market. I think we can agree on that, certainly relative to other regions. So do you think that's justified given what you're hearing and what you're looking at?
It's a great point, Peter. And if you looked through the low point on Friday's close, which was the low at the time that we were having this conversation, we're down about 8.7% from the January peak. And that's, definitely, one of the lower impacts that we've seen in equity markets around the world. I think that the top-down discussion, I tend to be more of a bottom-up strategist, but I would say from, kind of top-down peers around the street, it's really been emphasizing that the impacts are worse in Asia and Europe than it is in the US. And what I'm seeing from a bottom-up perspective in my own work, I think really supports that. And I'll kind of give you 2 data points on that. Shortly after the war broke out, we did a survey of our US equity analysts, and we asked them to gauge impact to earnings from the oil price shock if oil stays above $100 for more than 4 weeks. We asked them to gauge direct revenue impact from the Middle East exposure, and then we asked them to gauge the impact to their industries from knock-on effects, so hits to confidence and things like that. And I'll spare you all the details, but they had a number of different answer choices they could give us. And excluding the energy analysts, when we looked at the rest of them, 72% gauged the earnings impact to be low. 77% gauged the impact to revenue from Middle East exposure to be, kind of in the low category. And 66% said the impacts from knock-on effects would be low. Now, we did ask the analysts to consider a conflict that lasted for an extended period of time, which we defined as more than 4 weeks. So, we're sort of hitting up against that now. But I would say that's sort of the bottom-up, kind of summary that the sell-side community has been giving. And when we looked at their analysts by sectors, it did really see that the risks on all 3 of those questions were concentrated in the consumer and materials sector. And we're hearing a lot about those in the news. But if you look at some areas that our analysts thought would be more immune, utilities, healthcare, communication services, there's plenty in the U.S. equity market that the bottom-up crowd, thinks has some inoculation. And I would say, Peter, I've also been spending a lot of time reading through company transcripts on conferences and earnings calls, small, mid, and large companies. Those have kind of dried up now that we're kind of at the end of the quarter. But we were seeing a lot of support for that. We saw a lot of companies saying it is too soon to know what the impact is. We're not seeing direct impacts yet. We're doing stress tests. We're doing scenario analysis. A lot of discussion of supply chains and potential impacts there. But companies were also emphasizing their ability to manage through past issues. Some references to having a quarter or 2 of inventories. I think we'll hear about that more in the next reporting season. And then hedging by the companies themselves, has also been coming up in conversations. So I think that's where we are now. I would say overall, I do think similar to what we hear from investors, companies are sort of painting more optimistic scenarios along the lines of a shorter duration conflict. So things do seem to keep coming back to this idea of shorter duration. And just one other data point I'll give you on this. If you look at valuations in U.S. relative to non-U.S. Global developed markets areas, I think that the Iran conflict came along at a time that gave the US an opportunity to be resilient. And what I mean by that is if you looked at a relative PE between the US and the rest of the world, or at least other global developed markets, versus the 5-year average, we were way below that 5-year average as this conflict broke out. So, in other words, the US looked cheap if you were taking a 5-year time horizon relative to rest of world. And if you zoom out and look at it on a 20-year time frame, we had really given up the valuation premium in the US. We had seen that relative PE between US and non-US come back down to the 20-year average. So the door was open from a valuation perspective to give the US a moment to be resilient. I think in terms of what got us there, de-risking because of AI fears, de-risking because of private credit. There was frankly also some de-risking because of the Iran war that happened earlier this year, and other issues like Greenland. So I think that we had done enough de-risking in the US to give us that opportunity here to enjoy this outperformance.
Fascinating. So you've been talking about these longer run indicators that you're looking at, but I know you're also tracking tactical indicators, particularly since the war began. So what signals are they sending you right now from a tactical point of view?
So I'd say there are two that we're trying to stay laser focused on, Peter. AAII net bulls as a gauge of investor sentiment, and then the Russell 2000 forward PE, which is also kind of a gauge of sentiment in addition to being a valuation gauge. I would say what both of these indicators are telling us is that we have priced in a significant amount of fear in the US, but I disagree with some of the other strategists on the street who say that valuations or sentiment are at hold your nose and buy levels. They're not reasons in and of themselves to buy. If conditions change, if the narrative, is truly improving, enough fear is in the market. But I don't think these indicators, suggest that we're just completely washed out at this point. I think that's an important distinction based on how things change going forward. If you look at the Russell 2000 PE, as of the Friday low, we were at 14.98 times. That's a little bit below the average of 15.2. But importantly, if you look back to the broader market lows of 2022, 2023, and 2025, we went below 13 times. 11 to 13 times is when small caps price in a recession. So you want, as for a hold your nose and buy signal, to look for that most cyclical part of the market to be pricing in a recession. It's much, much improved. It's just not in that recession zone yet. If you look at AAII net bulls, we've seen kind of a bit of a collapse in sentiment over the past few weeks. We are between -1 and -2 standard deviations below the long-term average if you look at the 4-week average. Now, that is consistent with kind of a shorter duration, shallower pullback, what we would call a tier 1 drawdown of 5 to 10%. But if you really want to see things look washed out, you have to go back down to -2 standard deviations below the long-term average, which is what we saw in 2025 around the tariff episode and 2022, and also what we saw back in the great financial crisis and the 1991 recession. So a lot of pain has been inflicted, but I would just sort of disagree with the idea that we are just completely washed out from either sort of a sentiment or valuation perspective. Things look better, but we're not at that hold your nose and buy level.
Thank you very much, Lori. In fact, thank you very much, guys. Izaac, Rob. This concludes our episode of Macro Minutes for this week. We hope you're going to tune in again next week when we will have our monthly European edition coming up. So thank you, everyone, and stay tuned.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.